Hey everybody, it's John King, and it is Friday, the 28th of July, almost back to school time for most of us, and hopefully you've had a great summer vacation with the family and looking forward to getting the kids back to school and being able to have a little more consistency in our lives. Anyway, I know we are. So here is what I want to talk about today. So 4 topics I want to cover today. The first one is love the loan, hate the home. We've heard all about marry the house, date the rate. Well, the new thing is love the loan, hate the home. And so what does that mean? And what does that mean to you? We're going to talk about that. The second thing we're going to talk about is how to get your offer accepted. This market is super competitive. It's getting more and more competitive. And so I want to help you come up with some ways in order to get your offer accepted. The third thing we want to talk about is the Dream for All relaunch. Super excited about the Dream for All program. And I'll be talking about the relaunch and some details on that. And then the final thing is the Fed prime rate. The Fed just raised the prime rate to the highest that we have seen in the last 22 years. What does that mean? Where are we going? I'm going to cover all of that and more. So join me and let's go ahead and get started. First of all, love the home, hate the loan. That's kind of the new motto that a lot of people are feeling. Like a lot of first-time home buyers, we're telling them, and I don't know that I love this phrase, but we're telling people, look, marry the house, date the rate. Like the rate's just temporary. Rates will come down. We were hoping they'd be down already. They're staying higher longer. And I've got information today that you'll hear in a little bit about what's going on with the Fed and why. But the bottom line is, down the road, you'll be able to refinance that home and get a lower monthly payment. And so find the house you love, and then you can refinance later and get the rate you love. Well, a lot of people are in the opposite boat. A lot of homeowners are in the position where I love my loan. I love my rates. I don't like my home. And so they're completely opposite. And so we kind of coined the phrase of love the loan, hate the home. And what the heck do you do at that point? Because you feel handcuffed by the fact that, wow, I've got a 3% interest rate. And if I'm going to buy a new home, I'm going to have a significantly higher monthly payments because my interest rate is going to go from 3% to 7%. And now I can't afford, even if I bought the same priced home across town because I want to be in a different neighborhood, I'm paying a much higher monthly payment because the interest rate is going up. Here's the fact. That is a very true statement. But there's a different way to look at it. This is not true for everybody, but unfortunately is true for a lot of people. You've been hearing me over the last couple of weeks talk about consumer debt and how much our consumer debt has gone up. Well, here's a strategy that I've talked to a couple of clients about recently that I want to start talking about publicly, and that is press the reset button on your total monthly payments as you transition from the home that you don't love to a home that you do love. Now, what the heck does that mean? I'm going to oversimplify this. Let's pretend that you have a home that's worth $500,000 and you owe $250,000. So you're going to sell that house and you're going to walk away with, I don't know, $225,000 after paying fees. Now, the problem is you're saying, John, I'm going to take that $225,000 and I want to buy, instead of a $500,000 home, I want to buy a $600,000 home. Well, your loan amount, you're putting $225,000 down on $600,000. So you're going to owe $375,000 instead of $250,000, but you're actually going to owe more because you're going to have the fees associated with buying the home. So instead of owing $375,000, you're going to owe $390,000 when so you're buying a $100,000 more expensive home, but your loan amount went up by $140,000. It went from $250,000 to $390,000, and your rate went up. So now you've got an interest rate, instead of 3%, you're at 7%. That payment becomes unaffordable unless you have other debts that you're paying high interest on. I had one client I was talking to that has, a couple of cars that he just financed for 7-year loans. On top of that, he's got a lot of credit card debt. He's got he bought solar and a new HVAC that he's got a debt on his home. He's got a lot of other debts. The truth is he's got about $100,000 of other bills that he's making really high interest payments on. So he didn't want to sell his house because he didn't want to lose his 3% on $250,000, but he's paying around 18 or 20% on average for the other $100,000. So what I showed him is, hey, how about we sell your current house? You don't love it anyway. You don't want to be there. We sell your current house, and instead of borrowing $375,000, we borrow $475,000. He says, John, that's silly. Now my payment's going to be even higher because I'm borrowing $475,000 with a 7% interest rate. And I said, but you now have zero other monthly payments. And we added up how much his other monthly payments were, and the combined payment between his old house and his monthly payments on his other debt was more than what the new payment was going to be, borrowing $475,000 on the new house, the $600,000 house he wanted to buy. He pressed the reset button and said, hey, I'm resetting. Now, some people say, John, that's a horrible idea, because why do I want to press the reset button by including my car loan that's only going to pay off in 7 years and paying it off over 30? Here's why. Because we expect in the next couple of years rates to come down. And so when rates do come down, you refinance to lower your rate, yet you continue paying what you're paying today. And therefore, you're going to pay off everything faster. You're going to pay off the house, which includes the car, which includes the credit cards. You're going to pay it all off a lot faster, and it's tax deductible that is currently not tax deductible. That reset button is huge right now, and it's a strategy I really want to help people understand. If you have a decent amount of equity in your home, but you have a lot of other debts, we need to think about, hey, if you don't love your home, you can actually save money on your monthly payments by moving to another home, even though your interest rate's going up significantly. I know this is a little bit, it's a math problem that for a lot of people, they need to see the numbers. I understand that. So for some of you, you're going to listen and you're going to get this right away. For others, you would need to see it on paper. Either way, give me a call so I can show you what it looks like, because it might be the game changer that your family needs. Press the reset button. You save a little bit off your monthly payment, and you still have the ability, as rates start coming back down, to lower your rates and either lower your payment, but more importantly is keep making that payment that you're comfortable with, and it pays down everything faster, and you end up owning your home significantly sooner. All right, second topic I want to talk about today, how to get your offer accepted. This is a super competitive market, and it's getting to be as competitive as what we've seen in 2020 and 2021 when rates were at 2.5%. Now, back then, you had a whole bunch of people who wanted to take advantage of low interest rates that had been sitting on the sidelines for 10 years. And they had said, I don't really want to buy a house. I don't think buying a home is a good idea. And so they sat it out until rates came down. Now, everybody rushed the field to buy a few homes that were listed for sale. And then when rates went up over the last year and a half, everybody said, oh my gosh, the housing market's going to crash. It hasn't. House prices, they said, are going to crash. They haven't. They haven't kept going up. But here's why, because so many people that own a home right now have a super low interest rate, and they don't want to get rid of that rate. Now, if you weren't listening, I said earlier on a previous segment of this video about the pressing the reset button, because if you love the loan and hate the home, you might be able to press the reset button and make a move. But most people aren't pressing that reset button. Most people don't even think about that. And so they're not listing their home for sale. So we have a lot fewer people wanting to buy, even fewer people wanting to sell. So it's very competitive. Prices, people are offering over asking price. People are waiving contingencies. There's a lot of strategy that has to go into the market right now to get your offer accepted. And it's going to get worse once interest rates come down. So I have a live stream I'm doing today. By the time you watch this, a live stream will have already been broadcast. So there'll be a link to that live stream down below. You need to watch that video to get all of the details about what I think you need to do in order to successfully navigate today's waters and get an offer accepted on a home. Because most of the time, most of my buyers are not out to write offers. They're out to get an offer accepted, because there's a lot of emotion that comes with deciding to write an offer on a home. And for most people, they picture themselves getting that home and moving in there, because otherwise, why would you want to write an offer on it? Well, the problem is you're setting yourself up for disappointment. So instead, let's set you up for success by talking about strategies. So listen to that video so I can share strategies for how to get your offer accepted in today's market. The California Dream for All program, we got an announcement a couple of weeks ago from Cal HFA that they are going to be giving us a timeline come this fall. So we are getting closer and closer to the next $200 million being released. I have received some insider information about what the Senate subcommittees are talking about, some of the things that they're bringing up. And I'm going to be talking about all of that this Monday night. So at 7 p.m., Monday the 31st, I'm going to be having a live Zoom webinar that will talk all about what the previous rules were, what I think might be changing, what they're talking about changing, and how to get yourself positioned. So if you or someone you know are a first-time home buyer that has not owned a home for the last 3 years or lived in a home owned by their spouse, you could qualify for this program that originally was a 20% down payment from the state of California, and they would share in some of the appreciation of the home. Now, a lot of those details I expect to stay the same in the second version, but most importantly, join me Monday night, the 31st at 7 p.m., because I'll be giving a lot of detail about what I know, what I think, and what I expect to help you and your loved ones be prepared to take advantage of this program, because once it comes, it's going to go very, very quickly. Last topic I want to talk about today is the Federal Reserve. This week, the Federal Reserve raised interest rates again, and literally we are at the highest rate in the last 22 years. So there's two different rates you want to think about. There is the Fed discount rate. That's what banks actually charge each other, and the Federal Reserve sets that number. They raised the rate to 5.5%. Now, there's another number called the prime rates. The prime rate is actually 3% above the Fed discount rate. So the prime rate, the Fed rate was down to zero, between 0 and 0.25%, back at the worst of the pandemic, when the pandemic first kicked off. So we've gone up by 5.5% in the last 2 years. Okay, we used to have a prime rate at 3.25%. At one point. We're now at a prime rate of 8.5%. Most home equity loans, home equity lines of credit, most car loans, personal loans, almost all credit card loans are based on that 8.5% prime rate. And they say prime plus 1, prime minus 0.5. That's what you'd see on a home equity loan or line of credit. On a credit card, it's prime plus 15. Well, guess what? When the prime rate was 3, prime plus 15 is 18. When the prime rate is 8.5, prime plus 15 is 23. So huge difference in interest because of the prime rate changing. It's now at 8.5%. That's a huge bump. You've seen that in your home equity lines of credit because they're variable rates, and those rates have continued to go up. What does this all mean? What it means is the Fed is worried about inflation. Now, today, we got another inflation report. As a matter of fact, it's the most important inflation report the Fed pays attention to. The Fed's target is they want inflation to stay at 2% per year. We are right now at 3%. We were as high as 9% a year ago, 13 months ago in June of 2022. So we went way up to 9. We've come back down to 3. We are 90% of the way there. But the last 1%'s the hardest. Yeah, the last 1%'s the hardest because the huge volatility shifts way up and then the huge volatility shifts back down. But it's that consistency of staying low in inflation. And there's too many variables right now. So the Fed said on Wednesday, hey, we think interest rates might still go up even higher. It's going to depend on the data. And the markets are reacting to that, and mortgage rates are predicting what the Fed's going to do down the road. The mortgage rates already knew the Fed was going to raise rates by 0.25% on Wednesday. So on Wednesday, when the Fed did that, and Jerome Powell said, look, we're really going to base this on the data and what comes out as to whether we should raise rates more or stop. So he didn't say we expect more rate increases. That's really, really good news. But it means that the traders who make decisions on mortgage rates, they've now got tunnel vision. They're now staring at the data every single time they see data and saying, what's that mean? So what happened yesterday on Thursday, the data was all strong. Strong data means the economy is doing well. An economy that's doing well means people are making money. And if people are making money, they're spending money. And if people are spending money, inflation keeps going up. So good news economically is bad news for mortgage rates. And that's what happened yesterday. Now, it coincided with the weekly rate publication of the weekly rate average. And I've talked about this before, but I want to cover it one more time. I'm sure I'll cover it more times in the future. But the weekly rate average is sent out to lenders on Monday saying, hey, where are interest rates right now? And you need to respond by Tuesday. So Monday, Tuesday of this week, they were responding with where interest rates were. And then it's published on Thursday. So the problem is Monday, Tuesday, the average rate was 6.85 approximately. And it actually came down just a little bit on Wednesday. And then it shot up on Thursday because of the data that showed strong economic performance. And so we were in the sevens. We were at 7.1, 7.2% yesterday on the same day that the news said rates are at 6.8. That can be pretty confusing as a consumer, as a home buyer, as somebody looking to do a loan. And you're saying, wait a second, John, you're telling me the rate's 7.1. The news literally said today the rate is 6.8. That rate was not today's rate. It was just published today. It was 3 days ago. And there are variables even on that day based on what type of loan you're doing. Are you pulling cash out or not? How big of a down payment are you putting down? What's your credit score? And what's really confusing to people is they say, well, John, I'm putting 20% down and I got great credit. So that means that I have the lowest risk. I should pay the lowest fee. That's just not true. As a matter of fact, 20% down is a pretty high risk loan. 40% down is where they consider it low risk. 70% down is the lowest risk. So 20% down is a risky loan because the mortgage industry is accepting all of the losses. If you put 15% down, then there's a partner called the mortgage insurance company that is covering some of those losses. So don't think, oh my gosh, I'm putting 20% down. You must love me, John. You're going to give me the best possible deal. First of all, I'm going to give you the best possible deal that I'm allowed to give. The problem is I don't control the risk. I don't control how the regulators look at that risk. 20% down is not considered a low risk loan by any means anymore. So guys, I hope this helps. We are not sure where interest rates are going in the near term. We're going to see a lot more volatility. Literally, the inflation report, right, like I said today, shows good news, shows that inflation is coming back down and it's down at 3%. So the rates are coming back down some today. We're seeing rates maybe around 6.99 today, which is great. Not the 6.8 that was published yesterday, but not the 7.2 that really was the case yesterday. But we're going to continue to see that kind of volatility from day to day. And that's very stressful for people who are looking to buy a home and are out shopping, because your interest rate depends on the day that you get your offer accepted. And then we go in and we lock your interest rate. And the problem is we can't predict the future. It's easy to look in the past, but we can't predict the future on what's going to happen in such a volatile environment. So we really can't time the market when it comes to locking your rates. It's kind of luck of the draw. But hopefully this information helps. Continue to tune in weekly. Please do me a favor, share this information with anybody and everybody that you know that you think could get value out of my weekly videos. I'd love for them to subscribe. You can click down below. If you're not subscribed already, you can get our weekly update emailed to you. And also you can subscribe via YouTube so that you get these updates and all the other videos published, and click the notification bell so that you know every time I publish something. Thanks so much for listening. Hope you have an absolutely wonderful weekend, and we'll talk to y'all soon. Bye-bye.